So now that the day is done, the closing bell has rang on Wall Street. Just a brutal day for the market.
Yeah, absolutely. Friday's jobs report continued to send ripples through the stock market. You can see where the Dow finished today. Hopefully it'll come up in a moment here, but it shed more than 2.5, closing down more than 1,000 points. And it's just been, I mean, the big story, honestly.
Yeah, most difficult day for the S&P since 2022, to put that into perspective. So what does it mean going forward? A key measure of likely volatility in the stock market reached its highest level in more than 4 years. The SIBO Volatility Index is often referred to as Wall Street's fear gauge. The VIX broke about 65 this morning. That's a jump of more than 40 points since Friday, but it cooled back down quickly, ending the day at 38 points. The VIX last hit its highest level in March 2020 after the Federal Reserve took emergency action during the pandemic. The index is based on market pricing for options on the S&P 500. National correspondent Nick Harper joins us now from Washington. Outside of the Fed, Nick, what led to this meltdown today?
Yeah, outside of the Fed, as you can see, it's a construction site behind me. They're rebuilding the Fed at the same time that they're trying to rebuild the economy after a brutal day on Wall Street. As you mentioned, it was really all sparked by that disastrous jobs report on Friday, showing that the U.S. economy last month only added about 114,000 new jobs, well below expectations. And we also saw the unemployment rate creep up to 4.3%. So we've seen a 0.5% rise in the unemployment gauge in the last 12 months. And when that happens, there is some fear that we may be heading towards a recession. Added to that, we've certainly seen not a great earnings season. Quarterly earnings for many of the big companies, including tech companies like Tesla and Apple, have missed expectations. And there has been some concerns as to whether AI stock, which has been roaring over recent months, is now beginning to slow down. So you put all of those things together and it proves disastrous for investors and traders, and that's why we've seen that sell-off. Started on Friday, continued when Asian markets opened first thing Monday morning, and then European markets picked up that volatility before US markets opened once again, and we saw that downward dive during the course of the day. It's now a question of what needs to be done to try and stop that slide. Is it the Federal Reserve that needs to jump in to cut interest rates? There is some thinking that perhaps they missed their window. They met last week. They don't meet again until the middle of September. Could they do an emergency rate cut? It's very rare, but it is something that they could potentially do. They did it back in March 2020 at the beginning of the pandemic. So it is an option that they could potentially use if they wanted to try and stop that slide.
And Nick, I mean, there's so many questions that you raised there, that are left unanswered at this point. But you mentioned, the impact overseas. I mean, why are economic concerns in the U.S. Causing this ripple effect? You mentioned the Asian markets as well.
Well, exactly. I mean, for the Nikkei in Japan, we saw one of its worst days since 1987, down 12%. On top of that, European markets in London, the FTSE, in Germany, the DAX dropping about 2%, 1.5% down for the CAC 40 in France. I mean, it has been a very difficult day, and part of the problem is that they look at the world's biggest economy here in the US, and there is that concern that if there's volatility here, it is catching. So we have that domino effect. It's really a question now of how long this contagion will last. Asian markets open up in a few hours' time at about 8 p.m. Eastern. At that point, we'll begin to see whether there are those problems persisting on the other side of the world, and whether European markets and US markets, when they open on Tuesday, continue to have those problems.
All right, Nick Harper live in Washington, D.C. Nick, thank you very much. Joshua Dobie is with us now. He's a certified financial planner and the president of North Main Financial Group. Joshua, thanks for joining us. I want to zoom out. I mean, how does today compare to other bad days for the market? Just level set with us here.
Thanks, Lauren. Good to be with you. And a very appropriate question on a negative volatility day like today. Just for context, the market tends to move 2%, about 20% of the trading days. It tends to move 3%, about 10% of the trading days. So this isn't a unique occurrence, although certainly on a day like today, pretty stomach-churning and can create a lot of anxiety.
Yeah, and Joshua, I mean, let's talk about the Fed. Let's talk about interest rates. They're at 23-year highs. We saw the interest rates go up, and the goal of that, trying to cool inflation. But now you have concerns that those high rates are hurting employment. What does the Fed need to do now to address this going forward?
Great question, Chris. And that absolutely is the multi-trillion-dollar question that's sitting out there in the markets right now. The Federal Reserve Board and Chairman Jay Powell indicated last week that really a 25 basis point cut was very much on the table for their September meeting, and the futures markets indicated that. There's now some indication by the futures markets, especially with today's market movements, that a 50 basis point cut may be on the table for September, and perhaps then another cut in either the November or December meeting. That's significantly more than what we had anticipated market-wise even just a week or two ago, and that will have a significant bolstering effect on the markets, at least in the near term.
How likely is it the Fed would cut rates before its meeting in September?
Very rare does that happen. As was mentioned previously, that last happened at the front end of the pandemic. So to have what's sometimes called an emergency meeting or an emergency cut meeting in between regularly scheduled meetings is a pretty rare occurrence. It probably is not going to happen at this point based upon the data that we have, but there's a lot of speculation out there, and certainly anything is possible.
All right. Well, speaking of speculation, there's been a lot of talk about a recession. And you mentioned, Fed Chair Jerome Powell last week. He also was talking about the SAM rule last week. And that rule says that we experience a recession when the 3-month average of the unemployment rate jumps more than a half a percentage point in a year. So I want to play what he had to say.
We're aware of that rule, which is really I would call it a statistical thing that has happened through history. A statistical regularity is what I'd call it. It's not like an economic rule where it's telling you something must happen. I've been through some of the data already, but what we think we're seeing is a normalizing labor market, and we're watching carefully to see if it turns out to be more. If it starts to show signs that it's more than that, then we're well positioned to respond.
I mean, honestly, it's giving textbook when I hear that. So, when you talk to people, some of them feel like we are in a recession. They've been saying it since the pandemic. How do we know when we are in a recession?
Well, Lauren, you raise a great point there, because you have what Chairman Powell, which he is responsible to do, to give the very academic form of answer there. But then there's the practical, the real world aspect of things. And as you note, a lot of folks have felt like we have been in a recession for a long time. You look at higher interest rates, you look at higher inflation, which we've had here over the last several years, higher costs going to the grocery store, higher costs at the gas pump, higher cost of living, rents, mortgages, etc. There are many folks who have felt like we've been in a recession all along. So there's the academic end of things, which Chairman Powell, I think, noted appropriately there, that yes, we're not necessarily careening towards recession, and they do absolutely have a number of tools at their disposal. But then there's the practical, the real world aspect of things, which again, for many folks, has been a very real life experience.
And Joshua, what's your advice today for the average investor, that person with the 401k, and their concern seeing where the markets are?
For understandable reasons, Chris had a lot of these questions today, and that's very natural on a market day like we've experienced today. Yeah, so generally speaking, what we're encouraging folks to do, when we look at it historically, it doesn't make sense on days of significant negative volatility to radically change your plan. So we encourage folks, take a deep breath. I know it's a very anxious kind of time, a very anxious kind of experience when we see things move so negatively so quickly, but generally speaking, it has made sense to stick to your plan through these periods of volatility, not necessarily because it's going to bounce back immediately, but because a good plan over a long period of time tends to serve you well. So while it's really hard to do, that's what we're encouraging folks to stay.
All right, Joshua Adobe, always great to have you. Thanks for being here. Still ahead on Main and Wall, it is week 2 of the Summer Games in Paris, but not everyone gets to celebrate. How missing Olympic glory could mean missing out on major sponsorship deals.
And if you are stressed thinking about all the back-to-school shopping you need to do, just know you are not alone. Why the start of the school year is sending some families into debt.